You are fairly unique in the world of CPAs and people who are accountants because of a couple different things. One is you know a lot about business, just general business advice and understanding how business operate. Now you would normally assume an accountant would be able to do that, but I've actually worked with a number of accountants and you're fairly unique in that. Number two is that you create content. So this is where it starts to get really thin in terms of people with your pedigree, your background, with your strengths that actually make content. And I believe you're, if not the number one, but really high up there in terms of QuickBook experts, in terms of directing traffic and just being certified and all that kind of stuff. Your relationship with QuickBooks is quite powerful. Number three is that you like to do things other than just record videos. There's a whole complexity of things that you like to do. You're very active on social media, which is also kind of an anomaly. What do you attribute that to? Why are you like this?
I think that whatever profession I ended up doing was just sort of a choice. I think a lot of these things fall into our laps based on what we knew how to do at the moment, what somebody taught us was good, what we figured out how to make money in, and we basically got comfortable with that. So I would say part of the reason why I'm an accountant is because my life drove me in that direction. And if we were going to do a biography on me, I could tell you how that happened. But regardless, I'm an accountant now, but I'm actually a marketer in nature. Like my undergraduate degree was in marketing, and I always wanted to be in marketing. That was always the world that I liked. I learned how to program websites when I was 13 years old. My dad bought me a book that said, learn HTML in 24 days, in 24 lessons. And every day I read, and I was fluent in HTML 1.0. This is old school stuff. So I was always big into the techie stuff, and I loved websites and the internet and promoting businesses, and all the different places and routes in my life drove me to become a CPA. Now that I'm a CPA, I like to see the story behind the numbers. So whenever I prepare a financial statement or see a financial statement from a customer from the first time, I am not just interested on the tax effects or whether or not they're profitable or not. I'm actually very curious to ask the client, how did you get there? Can you tell me the entire story? How did you get here? And then I attentively listen because it is interesting stuff. If you mentalize yourself that it could be really interesting to hear somebody's entrepreneurial journey. And then through the process, I ask questions like, what were you thinking back then? Why did you make this decision? Why did you pivot? So by hearing everybody's story, I built sort of a keen interest for understanding people's entrepreneurial pathways. And the nice thing about social media is that most people are very excited to talk about their business. Like there's something about just like, I don't know if it's our ego or whatever, but anytime you ask somebody, tell me about your business, and whether they feel an opportunity to promote themselves or maybe a moment of pride, like somebody were to ask you about your children, people are very open about that. And I found out that if you hang out in social media, whatever it is, LinkedIn, Twitter, Clubhouse, and you ask people, tell me about your journey, people tend to open up a lot. And if you actually look at like business consultants, for example, people pay hundreds of thousands of dollars to get a consultant to tell you how to run the business or whatever. You can actually learn that by just asking other entrepreneurs, how did you do it? So I basically learned how to turn my ear on to everybody's entrepreneurial journey. I tend to try to be attentive, learn that. And that's how I became a consultant. And that's how I became what you tell me I am, which is someone that, quote, knows a lot about business and entrepreneurship. So I look at the numbers. Accounting is a language of business. I look at the numbers as a fundamental core of the story of what happened. I talk to the business owners to figure out how they got there. And then I take the power of the numbers and the power of the story and start creating the future, shaping the future. And that's what we call consulting.
Beautiful. There's a reason why I think you and I get along so well and why we see the world in a similar way, because in high school, I was on the path to possibly be pursuing accounting, but my grades weren't good enough and I wasn't as passionate about it as you were, or wasn't as disciplined about it as you were. But had things gone a different way, I would have been an accountant trying to then fulfill my creative urges and desires in content and marketing and design. But I went one way, you went the other. And so we're kind of meeting now back in the middle, where I'm very fascinated about business and marketing concepts. And so here we are. Now, You reached out to me recently and you said, Chris, I'm not sure if what you're saying is true. So let's start off this episode on a little bit of a spicy note. I want to share what I said, and then I want to get the professional's point of view because I'm not an accountant, not any sort of even closely resembling such a thing. I do remember something, and I repeated something that I learned a while back, and maybe it's just my memory's faulty. But one piece of advice that I have given other people, and you're going to get a chance to really set the record straight here, which I do appreciate, which is if you work for a nonprofit organization, that they have the classifications as a nonprofit. And we used to do some work for nonprofits like the Partnership for Drug-Free America, certifiably nonprofit. And what happened was the agency would then write us a note, and we didn't even know this. They just wrote us a note saying, this is the estimated value of the services. And I'm like, what are you giving me that for? That you can use it for your tax purposes. I'm like, oh, okay. I don't think we ever did, but that idea stuck with me. And then I repeated that on one of these shorts that I put out there. And you're like, whoa, hold on. This is a lot more complicated than what you're saying. I'll be quiet now. You tell us what the real deal is as a tax professional.
So when you do pro bono work, let's say for a charity, that pro bono work has some sort of market value, right? Website, graphic design, whatever it is, there's some market value associated with it. Generally, they are the ones that determine that, which is kind of an interesting piece. Like they don't tell you, hey, can you invoice me what the invoice would look like? And then we'll write that off. And like they usually don't do that. So because you're not going the traditional path of invoicing the customer and claiming that invoice as your business income, and then taking their letter to go, oh, it was donated, and taking it as a write-off to offset the income, because we generally don't do that. There really is no net value or deduction that you can take for the value of the services you provided. And that's mechanically what happens. What happens is because there was no income, there's no deduction to take against the income. If you were to, in fact, take the donated value of that pro bono work and claim it in your personal tax returns as a deduction, there needs to be an income somewhere because you have to be able to earn it to then be able to deduct it. So the net effect is basically zero because there's not a cash expenditure. And generally, the way it works with taxes, in order for you to take a deduction, there needs to be a cash expenditure or something that emulates a cash expenditure. Now, pro bono work, in where you pay your employees to be part of the project. You are using your equipment, you're using your office, you're consuming your business resources. You could always argue, hey, what about my cost of doing pro bono work? Well, I assume that cost, it's already included in your profit and loss report, because when you pay employees, that's an expense to your business. When you pay your rent and you buy equipment, so you already are claiming those things as deductions. So there's no additional mechanism to take, quote, additional deductions from giving pro bono work if you never claimed that pro bono work as income in the first place. So that's the long answer to your 1 minute video, right? And that's the technical answer. At the end of the day, it actually might even hurt you because especially like single member LLCs and S corporations, where most freelancers and professional service providers are, the charity is not even a deduction to the business. It's a deduction to you personally. And it's limited to, there's some moving parts in the personal tax return where it's limited the amount of deductions you can take for charity. So it might be possible that you can even go through the whole mechanism and it might not even be a net wash. You can end up paying taxes, more taxes for doing that. So that's why I poo-pooed your advice immediately. I did it privately though. But because of this is very difficult to explain, in a 140 character tweet. But that's the long answer.
Wonderful. So let me clarify something here, and I do appreciate it. First of all, I think we're friends and professional friends. So had you called me out on social media, I don't think you would have done it like chastising me. It would have just been, hey, for clarification from a tax professional point of view, what you're saying, it doesn't line up with my experience. I would know that your intention would be good, so there'd be no blowback or weird hurt feelings for me. But let me understand something. So I donate. My wife and I, we donate to different causes, and to say like NPR, for example, from a personal level. Maybe then what we do is we're giving them money, and so then that can be considered a tax write-off up to a certain limit, right? Generally speaking, like do you know what the limit is? Like say in California, generally speaking.
So for federal purposes, your limit is going to be 60% of your AGI or 60% of your income. So if you make 100 grand, you can donate up to 60,000 and you can take a deduction for that. It used to be 50%. That's why
Went up.
It does change, right? And you got to be careful because there's a lot of politics behind tax law changes. And for whatever reason, the decision to move that, this all happens pre-COVID, post-COVID, like anything is going on in the political world, they'll go back and change something in there. So the reality is you cannot donate 100%. It's limited to 60% for a public charity. And then after 2025, it might go back down to 50%. Small change. But the limitation on the top side is probably not as important as the floor and the bottom side. And that gets a bit more complex. So for example, let's say you make $50,000 a year and you have no other deductions, itemized deductions. This is like your mortgage interest, your state taxes, your medical expenses. If you donate, let's say 10% of your salary, which is $5,000, you're actually going to get zero additional tax benefit for that because you already get a standard deduction of at least $12,500 as an individual or $25,000 married filing jointly. So you might already be getting more deductions from using the standard deduction than using the itemized. This is why it's a crime, in my opinion, to call any sort of charitable contribution a tax write-off because there are floors, right? Minimums in which it starts making a difference. And there's also ceilings. And because most of these things are done in marketing messaging, like donate, get a write-off, you miss out a lot of that detail and context. That's why accountants are worth what they're worth because they'll try to figure out the answer to all these things for you. So for my general strategy is if you donate, when you donate, do it because you believe in the cause. Don't do it as a mechanism for a tax write-off because more likely than not, it's probably not going to make any difference.
Wow. This one question or this one rebuttal from you is opening up more cans of worms. And look, if you're driving and accounting talk is the stuff that puts you to sleep, change the channel now because I want to get even deeper into this stuff. Okay. Let me understand a couple of things and I'll say what I think I understand and then you correct me as I probably will butcher a couple of things. Some of us want to do good in the world. We want to support organizations that we believe in because it makes us feel good and plus they need the money. But we also want to get some tax benefit from that. So if you make $100,000 a year and you donate $10,000, it is your belief that you'll reduce your tax liability. Instead of claiming $100,000 of income, you'll have $90,000 of income. Is that the general idea? Did I get that right?
I think that most people think of it that way.
Yeah, but it's not that way.
But so the reality is that if you stack up your itemized deductions, let's say the mortgage interest of the home that you own, the state taxes that you live in California, so you're going to pay a crap load of state taxes. So you take those two things, you take the property taxes of your property. Now we get those three things. We potentially get some medical expenses for some surgery you got that you have to pay out of pocket. And all those things start adding up. And that number goes above and beyond the $25,000 married filing jointly standard deduction. Every dollar you pay above that, yes, you will get that logic of deduction. It will reduce your taxable income by whatever you put in there. But if you don't meet those floors, anything you pay in there is not going to make any changes in your personal tax return. So you rent your house, you don't pay, let's say you live in Texas, you don't pay state income tax, and you're married filing jointly, and you paid $24,000 of charity, that made absolutely no change to your tax return because you're going to take the $25,000 standard deduction.
Yes, I understood that part. That's the part a lot of people don't understand is that you get an automatic deduction of the floor that you're talking about. So if you don't exceed that, you donating $5,000, $6,000 for something, you help that organization, but you won't be able to claim that because you haven't even surpassed the floor. And this is a really important concept to understand. So what you're saying, first and foremost, do it because it gives you joy. If there's a tax benefit, then so be it. But you may want to consult a tax professional before you go and think about making a big donation that you think is going to benefit you from a tax point of view.
But I
Right?
do want to flip that on his head, right?
Okay, go ahead.
So let's say, for example, that we have St. Jude's, right? You believe in St. Jude's. Instead of donating to St. Jude's, ask St. Jude's what events are they running, and then go and be a co-sponsor of that event, a golf tournament. If you advertise in a golf tournament and you pay St. Jude's, that's actually a advertising cost, 100% deductible to the business. So you can help the causes by funding the marketing events that are going to get you marketing and advertising dollars, and possibly you help the cause and get exposure at the same time. So it's not always a negative tax idea to just donate. Just think about donation as a business expense and position your business and your brand in a place that you can use it as advertising instead.
Right. So there's some classifications we need to be aware of here. So you're saying you can avoid some of the donation minimums by doing something that's going to benefit your business, like marketing or advertising, which is something that you can expense. But if, let's say, you buy like a T-shirt or a mug for $20,000, is that going to work?
No. So you can't do like a pseudo advertising. Like you can't hide advertising costs inside a donation. A donation is a donation. But remember, these organizations don't just raise money on their websites. They do real in-person events. So forget about the T-shirt and a mug. Put your logo next to their logo in the big entrance of that public event or that fundraiser. So, and that's advertising. And you can take a picture of it, put it in social media, and you'll have your forever proof that you spent X dollars amount to co-sponsor X event with the charity of your choice that's raising money for that charity, and it's a legitimate business expense.
Right. So what if you bought a table? This happens a lot at fundraisers. You buy a table's like $5,000. It seats 8. It's dinner. And could you argue that was for me to network with the people that are coming to the charitable event? Is this a little bit harder to prove and to stand up if you're audited?
What a great question. Most audits are done in arrears, 2-3 years in arrears. So if you tell someone a story about a table where a bunch of rich people were hanging out, and you're like, I paid $10,000 for a meal there, and I was there networking, and 3 years later, when you're getting audited, you cannot prove you did business with any of them, that will be harder to prove. But if you can connect some sort of project to that contact, to that conversation, you can totally just label that as a business meal.
Right. But we do business meals all the time, and we do things like even advertising that don't guarantee any kind of business. So how does the government see the difference between the visibility of a banner, which I think is pretty old fashioned, or some kind of signage, versus me sponsoring a table? Now it's all of a sudden I have the attention of people in the room, like, oh, they must be doing something right. I need to go and talk to that person. And a deal might not materialize, but you could be invited to present at the company's shareholders or something where that could ultimately lead to more value than a transactional thing.
But is it a business value or a personal value? Because business value is measurable, right? With revenue, pretty much, right? Revenue or reduction in cost, net profit. Something like a spiritual value, like, oh, now I'm in the board of directors of XYZ, but I don't get paid anything for it. That's going to be very hard for you to trace it to. So your question is, what logic or what principle or what law or what regulation would the IRS agent use when trying to apply to figure out whether or not that $10,000 meals from 3 years ago is something that we can take as a deduction because you called it a business meal, but now there's no transaction to point to. So the IRS actually has written in their code ordinary, necessary, and reasonable. So they will go back to the ordinary, necessary, and reasonable logic, and they will write up, especially if you appeal this in tax court, they will write up and say, okay, Is it ordinary for, let's say, a website designer to sit down and talk to business owners of your target market in a table? Yes, totally
Yes.
ordinary. So
Yep.
that passes that. Necessary. This is the thing where you can say, well, you could send them an email, you could invite them to lunch in a regular, restaurant for $500, not 10,000. That's when then your side of the argument starts falling off, and then the death blow is reasonable, right? Most IRS agents that audit my clients anyway are significantly less rich than my clients. So you have a person that's using their judgment of what's reasonable and that's not reasonable, that drives an awesome Honda Accord, but the business owner is driving a Ferrari and deducting it from their business. The envy effect plays you'll be amazed how much of a psychological effect that plays on the IRS auditor. So you got to have really good arguments and be able to have documentation and connect an event to a transaction. So if you can't, it'll be very difficult to win with the IRS. And then if you take it to tax court, which is on the appeals process, then you have to make the same argument in front of a judge that looks at things a little bit different. And then that's where, the citations of previous cases and your proof and all that stuff comes into play. So long story short, have documentation, only claim things that you feel comfortable sitting in front of a federal judge and say, yes, I did this and this is necessary, ordinary, and reasonable from my opinion. So if you do that and you do that in good faith all the time, most of the time you will be okay.
Mm. Well, here's the real life case scenario, and I don't think we expensed it, but back in the day, we were working with an ad agency, and they wanted to honor one of the executive creative directors at the agency. And they encouraged us, when I say encouraged us, like, you need to buy a table. We've given you enough business, like millions of dollars of business. You need to buy a table so that we can have this gala celebrating this person. So in a situation like that, we bought the table. And then I only went, and then we invited our clients to sit at the table, not even our own friends, because that was the whole point. When somebody argues with me with that ordinary, necessary, and reasonable, if you're in my business doing what I do, that would be considered ordinary, necessary, and reasonable. If you're looking at it from like a lower paid tax accountant, is that an order that will? But no, that's not your world. It has to be relative to this, right? So in a case like that, had we taken the tax deduction for buying the table as, quid pro quo kind of thing to maintain healthy relationships with our clients, how would you argue that?
So anytime you talk about coercion or quid pro quo, you're going to have a challenge proving. But let's go back to ordinary. If at that event you have competitors in there, right? You have companies that do the same thing you do, and there's a public list of who attended, or like a thank you list, and you can say, hey, competitor A, B, and C are competing for the exact same business. This is a client that I've been doing business for 4 years, $1 million, like you said, $1 million worth of revenue. And in this event, I have 3 competitors that are going to start rubbing elbows with these people. This is necessary for me to protect that client. That could be an argument you can use. I would feel comfortable using that argument.
That's good. Yeah, because these things are generally filled with vendors and people who have done business with this. That's who pays for these things ultimately, because agencies rarely fund these things themselves, right? It's your honor and pleasure to do business with us. This is how we're going to get money back from you legally to honor our person. Okay, this is very good. And we went a little deep there, but this is, I think, necessary. And I think some people might be like, oh, I got some ideas here. Okay. So the government, as far as the IRS is concerned, they really just count money, cash, right? So if you give money, whether you are filing it correctly or not, but at least then that's a legitimate thing that's happening now, but they don't count and consider labor. So if you put in labor, like we want to do good for the world. So like we'll do 3 commercial jobs, get paid handsomely for it. And when an agency calls us up and says, we have a nonprofit, it's for a drunk driving campaign or something else, we're not getting paid. Can you guys do this? And you want to do it. You're just saying do it or don't do it. But there's really not a great argument for a tax benefit for you. Is that right?
So if I'm the individual, a solopreneur, and I get called to do the free labor, it's the same concept that we talked about at the very beginning of this, which is pro bono work and tax deductions and that sort of thing. So no. But let's say you have employees in your business and you pay those employees to do the work. Now, You're not going to shift your entire business model to do pro bono work for these people because you no longer have a business. But let's say you got less than 10%, 4 hours a week. You have your employees dedicated to this project. Well, what you're paying your employees in a way is going to be a tax deduction. So there's no need to like sort of separate it. You're going to get the deduction for it anyway. The problem with the non-cash expense, which is the labor of this business owner that's not going to draw a salary, that's the stuff that is just not possible to get a deduction for.
Right. Okay. Last question on this front. I have a friend, his name is Matthew Manos. He runs a company called Very Nice. Their business model is to give 50% of their services away to NGOs, nonprofits. It's how they market. He says, this is not an expense. This is not like something that we just do from time to time. This is built into our business model. It's clearly on their website. It's everywhere. And they talk about giving away half, right? So I'm wondering if it's actually part of your marketing thing, like Tom's Shoes, 1 for 1. Like Ethos Water, providing clean water for people in developing countries. Can that be considered a marketing expense then?
So for corporations, especially C corporations, we don't have these floor limitations. So when a C corporation, not a single member LLC, not an S corporation, makes deductions, the entire thing has a 1-to-1 deductibility for tax. So there's no need for you to sort of overthink it because it's a corporation. The corporation's contributing to the charity is a deduction to the corporation. So all these are corporations. Tom's Shoes, whatever. They're corporations.
Right. So that part's clear. But what if 50% of their time is spent quite literally working for nonprofits, getting no money from them, and that's how they actually onboard clients that pay them. Can the work that they're doing for those nonprofits be considered a deduction against income?
If it's not a cash expense, no.
Okay. Still consistent, even though it's part of their marketing and they're saying quite clearly that's their business model.
A deduction is a reduction of your wealth. IRS does not consider wasted time or invested time as a reduction of your wealth.
Yeah. This is unfortunate because this would then not allow as many companies to participate in helping nonprofits as much as they probably want to.
Well, I'll tell you why I actually agree with the law as it's stated now.
Okay.
Because the way I would give value to my hour, it will be different than the hour you give value to. The same value that a big, millionaire would give, their hourly rate to.
Right.
So if I was able to deduct some sort of hourly rate of my work, of my labor as a charitable deduction, what would stop someone from jacking up that rate to some crazy, or value pricing your donation, make it even more complex and funny to the conversation. So the reality is there's no real hard indicator of how much somebody's time will be worth. And that would be an administrative nightmare. So that's why it is the way it is.
I want to just say a disclaimer, since we have Hector here and he's a CPA, we're talking generally concepts and he's not here to give tax advice. So consult your accountant or CPA or anybody. And these are just general concepts.
So I would want to disclaim that I am a CPA. I'm a CPA in Florida. I work with clients all over the country, all over the world, really, because I work with QuickBooks. I do a lot of things beyond accounting. I will answer every single question Chris is asking me about his tax situation, some of his viewers' tax situations, things that were asked in Twitter. And I can only give generic answers based on the few facts and circumstances that I have. You cannot take what you hear from it is as tax advice. You have to have someone that's a tax professional, an EA or a CPA, look at all the facts and circumstances and then give you advice then. So I have to make that disclaimer as a CPA, but I'm always glad to tell you my opinion at the moment, whatever the question is. I will answer it as candidly as possible.
Okay, wonderful. All right, I'm going to ask you a good a good problem to have kind of question. In that, in the beginning of your business life, you're just worried about how to make money and stay profitable and stay afloat. And if you do that really well, you have a new problem. You're exchanging the problem of client acquisition and sales into I have an IRS tax kind of problem. And what I understand from the different CPAs I've worked with, and I've worked with a handful over the 25 plus years in business, is that they say you have a legal and moral obligation to legally limit what you owe to the government, but you can't do things that are against the law. You're going to run into a lot of trouble there. And so, depending on the level of risk that you have or tolerance, you might be advised to do certain things. So there's some savviness to it. But as I found out, even then we went to some very sophisticated CPAs, there's a finite amount of tax strategies that you can do to reduce your tax liability. Did I understand that correctly thus far?
You have the legal, moral, and patriotic obligation.
There we go.
To pay the least amount of tax legally possible, because that means that you are utilizing effectively and efficiently the resources that the government put in place. Paying the government more than what you're supposed to pay them funds the government more, makes the government bigger, and it creates a bigger problem than what it is. So you have a patriotic duty to pay the legal amount of tax, which is usually always a race against the bottom. Try to pay as little as possible with a disclaimer that you cannot evade tax. Avoid tax is legal. Evading tax is illegal. You avoid tax by doing all the things the government asks you to do. Because remember, there's a lot of social engineering that happens through tax. Like the government wants you to invest in equipment. Therefore, they give you a Section 179 deduction, allows you to take the entire equipment cost as a deduction, even if you finance the equipment. The government wants you to have children. That's why they give you a tax credit to have children. The government doesn't want you to have more than 3 children if you're a low-income earner. That's why the earned income credit stops at 3 kids. The government wants you to invest in smart people researching technologies. That's why the government gives you an R&D credit. So the government creates all these programs through the tax code system to engineer the way into what the big heads of government want the U.S. to look like. And they use the tax and financial system to try to reshape the future of the country. So yes, if you can take an advantage of paying the government less by utilizing the things the government told you to do, then why not? I mean, it wouldn't be smart to do it.
Let me put this in layperson's terms. We're talking about creating content on social media, and then you need to do what the algorithm wants you to do. So for YouTube, a little while ago, it was all about shorts, and then they were giving away free traffic. I understand on TikTok right now, if it's live stream, they'll give you the audience. They're going to give it to you. So the social platforms tell you, if you do this, we'll reward you by growing your account and giving you free eyeballs, and that's what most of us want. You're saying very similar things. Whoever is in office who helps to influence tax code, they want citizens of this country to do specific activities, and they'll reward you for it. So if you don't do these things, you're fine, but you're not using every resource, tool, and vehicle available to you in terms of acting and behaving that they want. And it's a game, so there's rewards and then there's penalties. And if you move towards the rewards, you'll do better, and if you move towards the penalties, you'll do worse. That's a general idea, right?
Right. And I can give you an example that's it's going to like click with everybody, right?
All right?
What was the industry that was hurt the most immediately during the pandemic?
Like
right?
Air travel?
Restaurants,
hotels,
yeah,
all those.
Restaurants, right? So forever, we've had a 50% limitation to meals. It's called the Meals and Entertainment 50% deduction. So up to 2020, if you're a business and you take a business meal, it was limited to 50%. The government said, you know what? 50% because half of it you need to survive anyway. The other half is a business portion. Well, guess what? For 2021 and 2022, because the industry, the food industry, the hospitality industry is so hurt, they said for those 2 years post-pandemic, we're going to let you take 100% of the deduction of meals. They're thinking this is going to be sort of stimulus to the restaurant industry because more and more businesses are sort of encouraged to spend money in restaurants. So that's a perfect example that is very recent, right? The pandemic affected everybody in the world, regardless of where you are, who you are, and how you're listening to this. The pandemic hit everybody, and everybody understood how restaurants were hurt. Now you can see the U.S. tax code, social engineering for a short term to try to solve this, or at least stimulate that industry a bit.
So how much of this is influenced by them social engineering, and how much of it you think is based on, well, the restaurant industry has very powerful lobbyists. And so there's lobbyists who represent the interests of their specific group. And then they go in and they bang on the doors of the congressmen or senators, whoever make these laws, and say, the restaurant industry is hurting, man. You got to do something for us. So then they're like, okay, we put you in office. Well, you better go do something. What are your thoughts on that?
I would say generally, if the tax deduction or the tax credit benefits an industry, you could bet that there's a lobby behind it. But like, for example, like the stimulus checks, there's no lobby behind it. Because there's no lobby that represents the American people making under $150,000 a year. No one really represents that. Or for example, the non-taxability of unemployment during 2020, right? So that's just a really interesting thing, which is unemployment income has always been taxable. It's income, it's taxable. Well, during 2020 specifically, it wasn't. And that wasn't a lobby. It's just politically popular, right? Politically popular. So anything that's politically popular, like child tax credits and things like that, they're going to be pretty much driven by the politicians. Anything that affects industries, like, for example, let's say 3 years from now, they start doing these huge deductions for people that go to college, like more than now. You could bet that the education industry is behind that. So I totally believe, although I can't automatically trace the food industry, the hospitality industry pushing for this deduction. I haven't done that research, to be completely honest, but I'm pretty sure you can find where there's going to be enough lobbyists pushing for something, and then this was the solution. Or it's kind of honestly, it's kind of a brilliant solution because it's very simple. There's not a lot of like moving parts. 100% deductible. There's no magic voodoo. If you spend the money in a restaurant, it's a deduction, right? So yeah, I agree with your assessment. The lobby industry does affect it. Yeah.
You weren't mincing words there. I was not sure where you're going to turn that conversation. I'm like 100% for sure it's involved. All right. I want to ask you a question I think a lot of the audience can relate to. And then I want to ask you a question that maybe only a few of the audience can relate to. So we're going to go low and then we're going to go really high. Okay. The first low question I have for you is this. Okay. I'm a content creator. You're a content creator. Okay. And there's certain things as entertainers, as people whose face is always on camera, like for example, my wardrobe. I spend certain money on skincare or like makeup, like powder for keeping my face from being too shiny, which I would not normally use if I weren't on camera. Is this deductible? So if I'm a fashion influencer, beauty influencer, and this is how I make money, and I'm spending this, is this deductible?
That's a brilliant question. So I'm going to give you with a low high, right? So I have a client who's a realtor, right? She's already a beautiful lady, right? But in her mind, she needs to be like a 10 to sell property, right? So she does her hair every week, spends a lot of money in makeup, actually has makeup people that go to her. She buys only really high-end clothing. We're talking about like really high-end clothing.
Yep.
This is like $1 million plus house listing agent only. And her argument has always been, I need this, I need this, I need this. I've done enough research for her to tell her makeup is not necessary, ordinary, and reasonable. A uniform is. So take your Christian Dior pantsuit and add a logo to it. That's like, like embroider a logo to that seems like fashion sacrilege.
Yes.
But if you do that, it is. Because the definition of a uniform is clothing that is not suitable for normal wear. And a company logo automatically makes it unsuitable for normal wear. The exception to the rule is a prop. So a prop would be something in your clothing that is part of your income generation. A pantsuit is not. You put a logo on it, it is. Everything else that she puts on that doesn't have a logo or matches the logo suit will not be. So the shirt under it, obviously the underwear, the shoes, the chains, the jewelry, none of that stuff would. Now, if you're on camera, so actors is a little bit different. If you are a performer or if you're on camera, in this case, YouTube in today's world, the makeup is actually going to be acceptable. The hair is going to be acceptable. Totally.
Very interesting.
There isn't enough cases because millionaire YouTube influencers that get audited has not created enough of an archive to go back and say, look, this tax judge said this, that tax judge said that. But what I can tell you just from using, and I'm going to cite the specific case, okay? There was an exotic dancer in the 80s, okay? And she claimed to have the largest breasts in the industry, okay? And she had tons of surgery to increase it, and consequently, surgery to fix other problems that came with just enlarging the breasts. She took all that stuff as a deduction, the correction, like the back surgery and the breast implants. She got audited. She lost the case in front of the IRS. It was appealed. It was taken to the tax court. Their tax lawyer cited another case about stage props, and they labeled her breasts as stage props. She won the case. Okay, so we take the case of props, whether it's physically attached to your body or not, and we use it to apply the same logic to anything else, right? So, for example, Chris, you wear a lot of hats. Okay, yes. A hat is not necessary or reasonable unless you're working in the sun or something like that, where you need, like, you're in your house, you don't need a hat. But your hat contains a logo of a brand that you work with, right? Or a logo of a brand that is your customer, or a logo of a brand of someone that you bring into YouTube Live or whatever, and it brings you more audience. So you can make a connection to that because that is truly a prop. For example, your prescription glasses, they're not, because you need prescription glasses to. Bottom line,
just
you need
function.
prescription. You need it. But if your YouTuber name was the shady accountant and I had to wear shades all the time, and my thing is I have different shades, right? Then those glasses would be, because those are prop, right? So that's where it's difficult to, like, sort of draw a line, because a lot of these things are sort of semantics, but it needs to be able to be called a prop. Everything in the background of your YouTube videos, everything, it's a prop, everything. So if I buy myself something that normally wouldn't be deductible, let's say a piece of art, okay? And I have it in the back of my video, and I make references to it, and I tell people I buy this art, so I'm successful or whatever, right? Like, of course, that's not my nature of content.
It's a set piece,
right? But that's a prop.
Yeah.
And that counts.
Okay. In the case of my hats, I don't intend on deducting my hats, but there's a real legitimate reason why I need to wear a hat. It's not because it's to block the sun. It's because if you have oily skin, it reflects the light and it becomes a lighting problem, because there's a hot spot on top of my head. So I started wearing a hat, and then it became part of my brand. And so now it's almost like I feel like I can't be myself outside if I don't wear the hat. And I've done tests before in front of a live audience that with the hat or without the hat, they're like, with the hat. We don't recognize you without the hat. We want the full experience. And so could you argue that then the hat becomes part of my uniform, one that I normally would not wear? Like, I don't wear the hat in the house. I don't wear the hat for any other reason except for I'm in public at a speaking event or on camera. So
yes, for ordinary and necessary.
Yeah.
Reasonable is when it kicks in. So if you buy a Gucci hat that's all blinged out for like $10,000, then that wouldn't, right? So that's where there's always a backstop to these things, and the backstop is always lays on reasonableness. Even if you don't want to argue the hat is your persona, and you want to argue that the beanies or the hat reduces the glare from the video, and you can prove that the makeup to reduce the glare and the time invested to reduce the glare by putting makeup in your head is more expensive than the hat, you can always tell the IRS, look, I'm taking a smaller deduction by buying a hat versus this other thing. So that's the piece where necessary kicks in, right? It is necessary for you to survive to take the smallest amount of deduction to solve this small expense to solve the same problem. So if you can make the connection for the refraction and the makeup for your bald head or whatever,
Yep.
I think you could win the argument very easily.
Okay. So here's what I've been told before by not my current CPA, but a different CPA. His argument is this. He would say something like, if you can reasonably explain it with a straight face and you feel like this is part of you have strength of conviction, then he says, let's take the deduction, because at worst we'll pay a late penalty, but we're not going to go to jail for this kind of stuff, for tax evasion. And a lot of things that you said, depending on how you argue it, very much like a legal case, you can win or you can lose. But if you have a 50% chance of winning and you think you have a reasonable thing and you're a tax professional saying it's reasonable, let's go for it, then you roll the dice, right?
So my argument to that is there's two ways to look at this. One is it's arguable, and two, it's a good argument. So when I get into my clients about, hey, I can argue X, but then I say, it's not a good argument, right? So just because we can sit here and grab anything that's sitting, in front of my desk, and I could just go on and make all sorts of arguments about why I can make, or why I could, or potentially could make that thing deductible. Just because I can argue it, that's not strong enough. It's like, can you make a good, like, your argument about how long it takes and how much it costs to put stuff on your head to avoid glare and replace it with a hat, that's a wonderful argument. That's a good argument. When my customers come to me with a good argument, I know they're equipped to give the argument to the IRS or to a judge. But when their argument to me, who they should trust 100%, it's weak, their argument in front of a judge is going to be much weaker because they're going to be much more nervous. Then I tell people, not a good argument. Come back with a better argument, and you're relying on my professional judgment because I could be wrong too, for me to tell you, okay, I'm a second set of eyes and ears listening to your argument, and I can say that looks and sounds like a good argument. The age of the CPA matters a lot, because the older the CPA is, the more audits they've been through, and the more interactions with auditors they had, and the more jaded they could be, right? And the more, let's say, practical they can be. Like my mentor, who passed away a couple of years ago, he was already in his 70s when me and him got into conversations about tax and audits. I used to textbook quote things from the code because I came fresh out of school, right? I was 30, fresh out of school. He would just toss those arguments and go, you know what? This is the reality. Boom, 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 boom. And what ends up happening is the more time you spend with auditors and the more they look at the flaws of the auditors, the human nature of auditors, the more practical they get on saying, you know what? Throw them a bone here, but not here. So let's not give them fodder to audit us with this small little thing that you're trying to argue till Tuesday, where you had this other thing that if they look into that, that's going to be even worse. So they end up being more practical. And like Blair Enns says, he says, if you're going to speed, don't do it with if you're going to have a body in the trunk, don't speed, right? So I've learned from that, from that concept that, look, if you're already sort of riding the edge in all the aspects of the business, don't take the stupid deduction by making your Ferrari a business expense as well, right? That's opening up a can of worms. So that's what ends up happening in the reality with all these concepts of arguable versus good argument, and should you push the envelope or not?
Yeah. Okay. One slightly related question on this is what we talked about the realtor who has a uniform, if it has your logo on it, and you would not normally wear that because it's like, are you at work? What's going on? That's clear. Good suggestion. Probably not that practical to some people. However, if I'm a content creator, is my wardrobe part of it deductible? Not everything I own, but certain pieces. Is some of that deductible or no?
So your regular wardrobe is not. If your channel is called the Blue Designer, all your blue clothing can. Does that make sense?
Yeah.
You make a connection to it.
Oh, okay. That was a short answer. So let me ask you something. I normally don't wear suits. The only time I wear suits is to be on camera or to do a workshop or something like that, because my business It's not normal for people to wear suits. Actually, it seems strange for you to wear a suit. So if I buy a suit because I want to look a certain way on camera, is that deductible then?
No, that would not be deductible.
Okay.
Right. With the exception of, like, let's say you have a YouTuber that is known for wearing suits. Like, they just wear a suit all the time. And they don't work in a bank as well to say, okay, you're also wearing the suit for this other thing. So that person can argue the suit is part of the uniform. But you can't, like, Chris, your situation is unique because almost every time I see you with a different piece of clothing. So if you want to make your clothing deductible, just put a logo on it. I don't know how else to say it, but
okay,
put a logo on it.
All right. So if the clothing or the things that you use, the props, are part of your brand, you have a stronger argument. So you have to think about that. So we're not going to talk about branding today, but this is something for you to think about. So plant some seeds in your brain. If it has a label that is matching with your brand, then it's very clear what it is. Or perhaps if your thing is to talk about men's fashion, then it's important that you are fashionable. And maybe there's an argument there, but under ordinary normal circumstances, it would be hard to argue, and you're probably better off not trying to take that deduction, right?
Correct. And I'll give you another a parallel argument.
Okay.
Let's say you buy a vehicle.
Yep.
And you want that vehicle to be 100% deductible. The way you insure it is you wrap it. You wrap it with your company logo, and regardless of how much you use it for personal, that's a wrapped vehicle. I mean, that vehicle is not designed for anything else other than advertising your business. So you wrap the vehicle, it's 100% deductible, move on. Make sure you take a picture next to it, put it in social media, have proof, because auditors look at social media. I'm going to give you an example. I had a client that was in the sort of movie business, and the movies are not so pure, let's call it that, okay? And this guy used to show up in social media in parties all the time, but in parties and parties and parties, right? I didn't know about any of the details about this, but he argued that he was entertaining clients, et cetera, and all these expenses were on the tax return, right? All these clubs and all these things. But he always put a picture of him kissing someone or being hugged by someone from the opposite sex, let's call it that. And it was just very, very obvious that there was a lot more fun than work happening. I don't know if that makes sense. That auditor actually used the social media pictures as their argument as to why those were not business, or there were not, those meals or that entertainment was not conducive to business. So if you have any sort of entertainment expense and you do it in a venue where you cannot discuss or close business because it's too loud, or there are too many distractions around, or there's alcohol, the ultimate non-business distractor, the IRS is going to use that as an argument, and you're going to lose it, because a 60-year-old judge that's seen everything, right? You are a 30-year-old kid, partying with your business money, saying that's ordinary, necessary, and reasonable. That's going to get tossed out in a second. So social media is really important. And like I said, wrap the vehicle, put your logo on. That stuff will secure that. Everything else, it just feels like fun and entertainment, and that's not going to help you in any way.
It's quite interesting because at the beginning of the show, you said, I don't just look at the numbers, I look at the story of the business connected to the numbers. When you talk about social media, it's about you saying, this is a legitimate part, and so I'm going to document it, so I'm going to tell the story, and so that in the event that I'm actually audited, there is some narrative here. And so the story that you're saying is, I'm a party animal, and it's inconsistent with how you're claiming in your tax return, you're going to have some problems potentially. So I love that you're talking about that. Back to the car. If you do a wrap, it gets right off. But I've seen, because I do loaner vehicles for my dealership, they have call this number service website on the window. So it's a decal or it's a sign on the side of the door. It's not literally a wrap because it's too obnoxious to wrap the whole car. Because if you get a rental car, a loaner, you're not going to want to advertise the dealership. It's too much, right? So in a case like that, when it's clearly a service vehicle with a sign or decals and things like that, but not a full wrap, would that count?
So if you have a van, right, you have a family of 4, you have a minivan and it's not wrapped, and you have a decal on it, that decal is not doing anything to help because it's not permanent, right?
Oh, it has to be permanent.
Yeah.
Or hard to remove.
Yes, correct. Can you deduct the decal? Of course. Can you deduct every single time that you drive without your family? Because you can argue it's all marketing and advertising and you're doing business errands. You can, but you cannot do 100% deduction.
Okay.
I said, if you want 100% deduction, no questions asked, wrap it. If you don't wrap it, then you're going to have to measure the miles and you can only take as deduction the percentage of business miles driven and not take the personal miles driven.
Here's the big question. Here's what I've learned in my life. When you start to make like real money, when you have like $1 million net income tax problem, you're talking about in the 40 percentile, maybe more, I don't know, in terms of your taxable liability, you start to get like, oh, I've done everything I can. And then what I learned in my life is that the really wealthy people like Bill Gates and Jeff Bezos, they have all kinds of tax vehicles that is, in my opinion, invented by rich people, snuck into the government on purpose. It's all like everybody's working for each other. There are legitimate tax vehicles that are available to super rich people that normal average citizens generally can't get involved in. Do you have an opinion on that?
We're talking about the famous tax loopholes, right?
There's many.
Yes. So the way people create tax loopholes typically is a combination of corporations, trusts, both in the US and outside the US, right? And these corporations, the trusts, they have contracts with each other where they contribute money, they pay services for one or the other. And all these things are really well documented with wire transfers, with emails, with staff in one place, staff in the other place, contracts, and that sort of thing. This is expensive, okay? So if you're a millionaire or a billionaire and you can afford to have a team of 10 accountants and 10 attorneys with network of accountant attorneys in different countries, and they can create all these vehicles to move money around and effectively reduce the amount of taxable income you pay in the US, but transfer that wealth to a different country where there's restrictions on how you can use it and when you can use it. You can do that. But for the average Joe that makes, let's say, under $1 million, right? And all their income comes from what's called ordinary income, from an active business, really the only low-hanging fruit strategy I can tell you immediately, this is how you save money, is by making less of it, right? And if you make less of it through what's called a tax deferral, which means, let's say you make $1 million, but then you put away $300,000 in a what's called a defined benefit plan, in a pension plan, you can, that year, the year you're a big earner, not pay 37% tax on those $300,000. Then when you retire, hopefully you're making passive income, all real estate, you're in a lower tax bracket, you pay your tax then, and you pay less tax. So tax avoidance through trusts and companies and transfers overseas, that's something that's really expensive and it's not elusive. It's real. It happens, right? When they publish tax returns, Mitt Romney, when he ran for president, he was paying 14% effective tax rate or whatever. Well, it's because a lot of his money was moved to a passive income. It was moved to overseas income. So it does complicate your tax return. It complicates your legal matters. If you die, right, the mechanism of getting your family that wealth, it's much more complicated. Whereas if you own one business or two businesses, everything is in the US, everything is in your direct bank accounts. You pass away, you pay the most tax, but your family will get the money immediately. There's no complication, no fighting. So I think about that too. But for the most part, look, without talking about the details, I'm a high income earner. I have income from my business. I have income from YouTube. I have income from my courses. I pay a lot of tax, and I hate it. I hate it. Right? I become very jaded about paying tax, but at the same time, it's a great problem to have. And if I don't need it now, then I'm going to defer it. So I'm going to tuck it away in a tax deduction vehicle, such as a 401k or a defined benefit plan or a pension plan, profit sharing plan. There's multiple of them, and avoid paying the tax this year and pay the tax later on. And that's just something to think about. Like once you become a high income earner, there's other weird ways you can do it, which is you can have your kids employed in your business, instead of just giving them money, pay them for professional services. And even if they're not going to do what you're going to do, have them learn. So my daughter, who's 13 now, she comes into my office, scans paper, organizes paper. We put it on payroll, right? And we pay her very little. She doesn't even have access to that money. It's her bank account is there. And we take that money and we put that into a Roth IRA. So when she's 40, 50, and I'm gone, she's going to have money she didn't even know it was there. And she earned it by working in my business. So there's simple ways you can reduce your tax liability without having to pay in all these complex vehicles and systems.
Wonderful. Hector, 3 things that people can do right now to limit or lower their tax liability. Just 3 rapid fire things that they can do.
1, have an accounting system. There are so many businesses that they go to their tax accountant and only thing they have is the 1099 K or the from PayPal or eBay or whatever, or they have the 1099 from the business that contracted them. So they only have the top revenue. Then they go to the accountant and the accountant tells them, this is your tax bill. And they say, well, you want to reduce that, you need to give me expenses. Then they're scrambling to find expenses from receipts, personal account, business account, and the exhaustion and frustration of looking for this information turns into settling for, you know what, screw it, I'll just pay whatever, right? So by having an accounting system all year long, knowing what you spend money on, maybe have a professional look at it and go, hey, where are your vehicle expenses? Where's your internet? Where's your cell phone? Stop paying it from the personal account, pay for the business account, separate those bank accounts. That is probably going to, this is the easiest stuff. That's probably going to give you just better information a year long. The second one is take advantage of the deferred taxes. We just talked about that. Take advantage of your 401k, of the IRA, of a pension plan, of a self-employed SEP. Take advantage of that and put some money away for your retirement because you're most likely going to retire with less money and with a lower income tax bracket, and it's a good idea. And third, if you're already a high income earner, shift income from ordinary income to passive income. What's passive income? For example, a royalty is a passive income. So if you can turn your revenue into royalty, that means you have to create something that matters, create something of value, right? You can franchise your brand, you can charge a royalty for somebody using your brand or your content. All that stuff, royalty, if you call it royalty, is ordinary. It's a passive income and it doesn't pay self-employment tax. That's going to be in a lower tax bracket. And also, what all the rich people do is they invest in the stock market, they hold the stock for more than a year or whatever they invest in, and then they cash it afterwards. Capital gain has a lower tax bracket as well. So keep track of your business expenses with a good accounting system like QuickBooks. 2, take advantage of deferred tax plans like IRA, 401k. If you have a job and they offer you a 401k and they have, let's say, 3% matching, that means that they will match up to 3% of your salary. If you're not putting 3% of your salary in a 401k, you're stupid because the company was going to double your retirement as an incentive to keep you on. So that should be easy. 401k with matching, you immediately do it at least the amount that the company is matching because it's instant money. You don't enjoy it now, but trust me, it's really hard to make money when you're 70 and no longer relevant with the metaverse and AI or whatever, things you need to know then to make money. So while you're young and smart, right, and you can do things and be functional, save money for your retirement.
Wonderful, Hector. Thank you very much for doing this with me. It's been a very spirited conversation. I learned a bunch of things that I hope our audience did as well. Where do people go to find out more about you?
So I prefer people to go to my YouTube channel. Just search for my name, Hector Garcia, in YouTube and subscribe to that. Obviously, I always want to grow my subscribers. That's the dream of every YouTuber. Most of the content in there is going to be QuickBooks related. But if you have a quick tax question, and I'll qualify quick by quick for me to answer, not quick for you to ask, right? Just email me, hector@garciacpa.com. If I could point you in the right direction, give you a general answer, I will do it. Of course, if it's a really long, complex question that requires me to look at documents and look at your past tax return, I would probably say, hey, we got to set up a consultation. But generally speaking, I like to help people, guide them in the right direction. So my YouTube channel and my email tend to be the best places for that. Hector at GarciaCPA.com.
We'll include the links in the description below, so check that out. It's right there. You guys don't do enough of that. Just check it in the description. We'll link to his channel.